Now, as we talked about in my last video on recession, it's official when the US economy has two consecutive quarters of negative GDP growth. Q1 of this year was negative 1.6 and Q2 was negative 0.9. So even though some are saying we're not really in a recession, these are the facts, folks. To many, it may not feel like a recession because recent history has us comparing our current economy to that of the Great Recession of '08 and '09, which was obviously terrible. But today, official unemployment numbers are low. The housing market is still competitive, but finally cooling off after going berserk for 2 years. And there's still a ton of pent-up demand for goods and services since the government essentially shut down our economy for well over a year. Most of you probably noticed last month's inflation report finally stopped rising, moving to 8.5% in July from 9.1% in June. That's year over year. And this is, of course, was due in large part to a very steep interest rate increase of 75 basis points in June and also in July, which these also happen to be the largest back-to-back increases that we've seen from basically since the central bank started using the funds rate as its chief monetary policy tool back in the early 90s. So there's no meeting in August, but in September, many are expecting another bump of 50 to 75 basis points. So you can get ready for that. Now, for the most part, the stock market has responded well to the most recent inflation data. Since the beginning of the third quarter, which would have been July 1st, the S&P 500 is actually up about 11%. And that's of the filming of this, which is August 26th. Now, if you're an investor with long-term perspective, you could say that we're still in a great buyer's market right now, since the market has really only recovered about half of what it lost in the first 6 months of 2022. Now, the naysayers would dispel this rebound as misplaced hope and label the uptrend a bear market rally. In other words, they're saying don't hold your breath because it ain't going to last. They would argue that a much deeper recession is imminent and it will arrive sometime in 2023. But even pessimists don't think it will last as long, and far fewer are speculating anything like what happened in 2008 and 2009. Now, most so-called experts say the Fed is in control of our economic destiny. Will their aggressive raising of rates stifle the economy to the point of throwing us into a deeper recession? And how will our economy respond to trillions of dollars of fiscal stimulus being injected in a very short period of time? Is raising rates even the right solution, one might ask? Now, was it our government or another that once infamously stated, if you think the problems we create are bad, just wait until you see our solutions? I say that tongue-in-cheek, of course, but unfortunately, since we've never traversed this road before, nobody can say for certain what's going to happen. And asking 10 economists what they think is like asking 10 doctors about your health. You'll likely get 10 different answers. Personally, I remain a skeptical optimist. I think things will improve, but we could be in for more bumps along the road. Trying to time the market is a failing endeavor. I keep talking about this in all my videos. That's why I've been working with a lot of my clients to dollar cost average when investing new money, especially if there's feelings of uncertainty about what's to come. This is the method that we leverage in our 401k plans. It's worked out really well for people that have contributed into the market for many, many years. And it kind of locks in a nice median price point since you're not buying in at the high or the low points every time. Now, is there a place for safety and caution in this environment? Absolutely. For some, that might look like holding some precious metals in their portfolio or beefing up their emergency account. For others, it could be diversifying into alternative asset classes like real estate, commodities, or energy. Municipal bonds could also be an attractive buy for those that are seeking income but want to avoid the higher risk of equities. Oftentimes, a diversified approach using many of these tools is the best strategy. And of course, the very unpopular thing to do would be paying off your personal debt like credit cards, student loans, and car loans. Doing this in uncertain economic times can only increase your peace of mind. So I would encourage that. Now, I mentioned annuities in my last video, and I think it's worth mentioning again. If you are fearful about the future and you think a big recession or market drop is imminent, there are products on the market built to protect your money by absorbing losses while still allowing you to participate in market gains. Some of these products can even provide guaranteed lifetime income that you can't outlive, kind of like Social Security. But at the end of the day, it all comes down to suitability and what's right for your specific situation. So reach out to me if you'd like to learn more and have a complimentary review of your circumstances. I appreciate you listening. This has been Matthew Holt of Christian Wealth Management, as always, bringing you comprehensive financial solutions from a biblical perspective. Until next time, be richly blessed.